In September 2024, a significant event occurred when China sold $53.3 billion in U.S. Treasury securities, marking the largest single-month reduction in history. This action draws a parallel to the crisis of September 1931, when foreign creditors began to offload British debt, leading to the collapse of the pound's global dominance. Historically, reserve currencies have followed a predictable four-stage life cycle, and understanding this pattern is crucial as we analyze the current status of the U.S. dollar. Every global monetary system over the last 400 years, from the Dutch guilder to the British pound, has adhered to a similar pattern. The first stage is adoption through strength, characterized by genuine economic dominance, trade surpluses, and a currency backed by tangible assets like gold, lasting approximately 25 to 30 years. The second stage, dominance through debt, sees power maintained through military and political influence. During this phase, trade surpluses turn into deficits, and debt accumulates to fund military expansion, lasting about 25 to 35 years. The third stage, crisis of confidence, occurs when debt reaches critical levels, prompting foreign holders to sell the currency. Central banks often raise interest rates to defend it, which can exacerbate the panic, lasting around 10 to 20 years. Finally, the fourth stage is replacement, where a new system emerges. The former currency does not vanish entirely, but its exorbitant privilege of being able to print money that others must hold comes to an end, typically lasting 5 to 15 years. A historical case study of the British pound from 1918 to 1944 illustrates this cycle vividly. At its peak in 1918, the pound settled 70% of global trade and was backed by gold. However, by 1925, Chancellor Winston Churchill's decision to return to the gold standard at an overvalued pre-war rate led to trade deficits. The crisis reached its climax in 1931, following bank failures in Austria and Germany, when investors panicked and demanded £200 million in gold in a single day, which constituted 22% of the UK's reserves. In a desperate attempt to stabilize the situation, Britain raised interest rates to 6%, but this failed to stop the bleeding. Within 72 hours, Britain abandoned the gold standard, and by 1944, the US dollar had officially replaced the pound at the Bretton Woods Conference. The evolution of the US dollar can be divided into distinct phases. Dollar 1.0, spanning from 1944 to 1971, saw the Bretton Woods system peg the dollar to gold at $35 per ounce. However, by the late 1960s, the costs of the Vietnam War and domestic programs led to trade deficits. In 1971, President Nixon suspended gold convertibility, marking the end of the Bretton Woods era. Dollar 2.0, known as the petrodollar, began in 1974 when the U.S. struck a deal with Saudi Arabia to price oil exclusively in dollars in exchange for military protection, effectively resetting the clock and creating a new stage one. The parallels between the end of the pound's reign and the current climate of the U.S. dollar are striking. In terms of debt to GDP, Britain was at 130%, while the U.S. currently stands at 123%. Both nations entered their respective crises with persistent, massive trade deficits. Geopolitical stress also plays a role. Britain was burdened by World War I debt, while the U.S. faces significant costs from the Ukraine conflict, potential tensions with Taiwan, and ongoing involvement in the Middle East. The foreign selling of debt is another alarming similarity, as China's reduction of U.S. debt from $1.3 trillion in 2013 to $774 billion in 2024 represents a gradual yet accelerating exit. Despite these alarming indicators, 4 critical buffers are extending the dollar's stage 3. First, there is no immediate alternative. Unlike in 1931, when the dollar was ready to take over, today's alternatives such as the UN, Euro, and BRICS currencies face structural or political hurdles. Second, the U.S. maintains military dominance, possessing the world's most powerful military. Third, network effects play a significant role, as the dollar accounts for 88% of all foreign exchange transactions. Finally, the market depth of the $26 trillion treasury market remains the most liquid in the world, providing additional stability. History suggests that while structural advantages may extend the timeline of the dollar's dominance, They do not prevent the inevitable transition. The U.S. entered Stage 3 in 2020, influenced by massive pandemic-era money printing and the weaponization of the SWIFT system, which involved freezing Russian reserves. If the 400-year pattern holds, the transition to a multipolar system, where the dollar shares status with other currencies or gold-backed units, is likely to reach its critical acceleration point between 2025 and 2030. The free ride of printing money for global trade is nearing its historical limit, signaling a pivotal moment in the evolution of global currencies.